Okay, let's explore this situation. It involves revenue recognition. It involves modification of a contract. So let me read the problem to you. On January 1st, 2017, Loud Company enters into a 2-year contract with a customer for an unlimited talk and 5 gigabyte data wireless plan for $65 a month. I'm just reading here now. The contract includes a smartphone for which the customer pays $299. Loud also sells the smartphone and monthly service plans separately, charging $649 for the phone and $65 for the monthly service for the unlimited talk and 5 gigabyte data wireless plan. On July 1st, the customer realizes that she needs less data in her wireless plan and downgrades to an unlimited talk and 2 gigabyte plan for the remaining term of the contract, which is 18 months. The unlimited talk and 2 gigabyte plan is priced at $55 per month, and the $55 price is Loud's current standalone price for this plan that is available to all customers. Okay, now what we have to do on this problem is answer the question, how should the company account for the contract modification? And then we need to provide the new monthly revenue recognition journal entry. Okay, so now we've got some new information on the bottom of the screen, and I'm going to read that. At the contract inception, Loud determined that each month of wireless data service, each month was distinct. Therefore, at the date of the modification, Loud determines that the remaining monthly service are distinct from the smartphone and unlimited talk and data already provided to the customer. So as a result, Loud allocates to the remaining performance obligations the remaining consideration to be received, and that's now $55 per month times 18 months remaining in the contract, less the amount that's already been allocated to the delivered goods or services, in other words, the contract asset. Okay, so this means that the contract modification does not add goods or services to the arrangement, and therefore this modification cannot be treated as a separate contract. However, to determine the appropriate accounting for the modification, what the company has to do is assess whether the remaining goods and services over the 18-month period are distinct or not distinct from the goods and services already provided to the customer. And in this situation, they are distinct. The goods and services are distinct from those already provided to the customer, right? Which was the handset and the 6 months of services. Okay, now you see the data in front of you to perform the analysis to come up with the answer of how much do we allocate per month. Okay, it comes out to be $44.70, but you have to follow through the logic here. 55 times 18 is 990. Okay, that's the new amount we're recognizing. But we have to first do is compute this allocated transaction price. So we put down the initial consideration of the phone, the 5G plan, the total consideration, the standalone selling price, and then we can compute the selling price percentage, right? We've got to break that into the pieces. Once we do that, we can then come up with the allocated transaction price. Okay, and to come up with those allocated transaction price, what we're doing is we're taking the total consideration of $1,859 times 29% to come up with $546 and spare change. And we take that same amount times 70.62, come up with the $1,312 and some change, okay? And that's how we come up with the total consideration. Now, probably the next piece of the analysis you need to understand or focus on is that how did we come up with this contract receivable? Well, we allocated $546.17 to the smartphone, and the initial consideration was $299. So the difference between the allocated transaction price And the initial consideration represents the contract receivable. Okay, so that $247.17 then gets factored in here as $247.17 minus the 6 months times the $10.30. Okay, so you may be wondering, where does that $10.30 come from? Well, we calculated that the contract receivable was $247.17. If we take $247.17 and we divide that by 24 months, right? It's a 2-year contract. You'll come up with $10.30. So that's the full amount. We're subtracting the 6 months that have expired. And that's how we come up with the remaining balance of $185.37. Okay, so as a result, the entity has $804.63 less to allocate to the remaining 18 months of service. All right, $990 represents $55 per month, right, times 18 months. That's where the $990 comes from. So that's the remaining consideration less the $185.37 that we just calculated. And so we have to allocate that to the remaining 18 months. So if we divide that $804.63 by 18 months, the final amount of the journal entry that we have to make is $44.70. And that was the original question. Okay, so now I've moved the screen so you can see the original question. What's the new monthly revenue recognition? It's the $44.70. Okay, this is a challenging question. I hope you found my explanation helpful.